Welcome to Steve Savant's Money, the name of the game. Hi everyone, I'm your host Steve Savant, syndicated financial columnist and money gamer extraordinaire. Is life insurance a good retirement plan option? Well, we'll talk about it with nationally recognized insurance product expert, Mike McGlothlin. Welcome to the show, Mike.
Great to be here, Steve.
Well, people always ask me this, Steve, maybe I should just do a Roth. Maybe I should do a life insurance. Why should I tie my money up? I have so many rules to obey, a lot of regulations. But isn't it really an authentically good plan to look at? Is it comparable? I can't deduct it.
Yeah.
So there's the first problem right there.
Well, I think that, first of all, full caveat here, depends on the situation. But if you're in a certain tax bracket, if your employer doesn't maximize or match contributions or does a small amount, then yeah, I think that it makes sense in a lot of situations due to cost standpoint, due to the back end distributions. And again, when you're doing income planning as a consumer, you need to be taking a look at not what you earn, but what you keep. Not only during the accumulation phase, but also during the distribution phase. It's what you have left over after all of the drag, whether it be taxes, whether it be cost of insurance, whether it be fiduciary responsibility in the 401k. All of those things you have to bring to your advisor's attention to comparing apples to apples.
Now, the first apple I'm going to compare as well, I am giving up, even if I'm middle America, and most middle Americans maybe are giving about $1,000, maybe $1,200 a year. They may be in the effective tax bracket after all said and done with deductions, credits and exemptions. They may be down to maybe anywhere between 18 and 20% in their effective tax bracket. I'm thinking, well, there's $200 that I didn't have to pay in taxes. It's in my hand. I never save it. I spend it, but it is still in my hand. Can I recoup that later on? Is that worth looking at?
Well, I think that when you take a look at, okay, here's my today benefit of $200, and then take that $200 out 20 years. Let's say that it doubles every 10 years, and probably very generous in today's interest rate environment. That's worth basically about $400 to $600, okay? The reality of the situation is that you may be putting aside $1,000, but you're going to be getting back, say, $1,700 at distribution, which is completely tax-free. So you've almost tripled the future value of that tax deduction in today's terms.
Now, why is life insurance in this income scenario that you're talking about, why is that tax-free?
It's tax-free because you can get your basis back.
Basis is what?
Is what you put into the policy.
So whatever I contributed, that's called basis.
So your $1,000. If you do inside a 401k, you basically lose that basis amount because you haven't been taxed on it yet. So if you take out the same dollar for dollar, that $1,700 from a 401k plan versus a life insurance plan, that $1,700 is going to be taxed at your highest marginal tax bracket because you're stacking it on top of your Social Security, other passive income that you might have. So it's going to get taxed at the highest rate. If you're taking out from a life insurance, that becomes tax-free because you're going to use basis first. And you can also manipulate the policy loan features so that comes out tax-free. Now, the caveat
so
there
you're
is
taking a policy loan from your policy, and that money comes out free because it's a loan. Like if I took I've heard about reverse mortgages. I could take free from there. So this would be the same.
Exactly.
So as long as I keep it enforced, now I have to keep this forever then, right? Because if I'm taking loans out.
That's the caveat.
Yeah.
You've got to really make sure that policy is well funded and it's going to last all the way to your life expectancy and probably beyond. Or you need to make sure that you have a policy that has a rider that will extend that coverage beyond that period. Because the risk there is that if the policy lapses, everything that you've taken out over those last 20 years of income distribution becomes fully taxable in that year. And so then you could be hit with a substantial tax burden because of the ordinary income tax at the highest marginal tax bracket at that point in time.
When I'm comparing qualified to non-qualified life insurance plans, I know in my qualified plan before 59.5, I could take a loan from my qualified plan. Can I do the same with the life insurance?
Yeah, absolutely. In fact, life insurance is probably a little bit more flexible. A lot of plans only allow 50% of the account balance that you can take. Or if you retire or change companies, you're limited to income distributions based upon Rule 72T or 72Q. So with life insurance, if you need it for emergency prior to that income distribution, you can access it without those government ERISA regulations.
Now, I brought up the 59.5. I know there's a if you try to take money out of your qualified plan, not as a loan, but you had to take distributions for whatever, and you didn't use any of the 72Q, would you not be subject to a penalty?
Yeah, taxation, full taxation,
Full taxation and
a 10% excise penalty on what you've taken out.
Now, do I have any of this issue with life insurance? I have none of that.
No, as long as you stick with non-MEC, non-qualified life insurance. And again, that's key with the proper funding levels.
Now, I notice in qualified plan and 401ks, I'm forced to take distributions under required minimum distributions, RMDs, at age 70. Do I have any requirements in life insurance in that regard?
None whatsoever. It's your assets you can take as is. And the other nice thing is that when you pass that account value on a 401k to your beneficiary, a non-spouse beneficiary, that's fully taxable for them in the year of distribution, which automatically puts them up to the highest tax bracket. Being a life insurance policy, that passes to the next generation completely income and estate tax free if set up properly.
Wow. When we come back from the break, we're going to talk about some of the impact that almost all qualified plans and other investments have on Social Security, but according to Mike, not life insurance. We'll be right back. It's not how much money you make, it's how much money you keep. And keeping more of your money is even harder these days with high taxes, fund expenses, and fees for financial advice. And when you consider the uncertainty of the market and the rising cost of living, the purchasing power of your dollar is constantly at risk. But a tax-deferred annuity with an inflation rider can be the most cost-effective way to generate increasing annual income without market volatility. For more information on how annuities may work for you, just email me at steve@thenameofthegame.tv and ask for our free annuity information. Welcome back to our second segment. Of course, I'm with insurance product specialist Mike McGlothlin. Mike, we usually don't think about life insurance as a retirement plan, but now you've kind of brought some ideas up in the first segment. Man, I need to look at this. If I'm not really in a high tax bracket, I'm not getting a match, and I have some tax issues when I take this money out, which sounds like a pretty good deal. I get my all money, I put into it free. I can take policy loans at very low cost as long as I keep the contract in force. But now I notice that my qualified plan, if I have a 401k and I take money out, I also notice that that number that I take out of my qualified plan comes over to my Social Security, and I could get my Social Security tax because of my retirement plan in a 401k. What's with that?
Yeah, under Social Security taxation, when you have adjusted gross income for married filing jointly, somewhere between 32 and 44%, at least 50% of your Social Security becomes taxable to you. And again, when you think about your income and taxing it and stacking it, that all of a sudden 50% of your $25,000 from Social Security is taxed at your highest marginal tax bracket. With life insurance, because you're making distributions from basis and from loans that are non-taxable, those are tax-free distributions and do not go into the provisional income. That affects the taxation of it. And more importantly, for some of the higher wage earners, it doesn't impact alternative minimum tax. So for many of your viewers, they may have to be subject to the higher of alternative minimum tax or your basic 1040 tax, whichever is higher. Your distributions from life insurance are not impacted inside the AMT calculation.
So I just want to make sure I got this right, and I'm talking strictly on these two product lines. So if I was to take life insurance, I took my basis, whatever I put into it, out, and I also took policy loans of my gain. I took that out, and I kept the policy in force. None of that income is going to be reportable on a 1040, and it's not going to show up on my provisional income test. Am I getting that right?
That's inaccurate because it does not impact your AGI.
So if I had no other income, would I, in truth, be taking both out free?
Yes.
Okay,
because you wouldn't be impacting your Social Security.
So if I don't impact my Social Security, and I'm using life insurance in this regard, that could be a big play because my qualified plan completely is taxable. There is no basis, and it actually falls onto the Social Security provisional income test to see what is going to be taxed on my Social Security. Now, thinking about this one last thought. Some people say, well, I don't mind doing non-qualified, Steve. I just don't want to do life insurance. I'm just going to do non-qualified mutual funds. I'm going to do non-qualified ETFs. I'm going to do maybe limited partnerships. I'm just not going to put it in a qualified plan. But there are expense loads that are going on in these as well. And you were saying, I heard you on one of our other shows, you said sometimes these funds actually have embedded taxation in them that we really don't see until we get our 1099 at the end of the year.
Exactly. Yeah. I think that one of the misnomers or myths about mutual fund investing is that when you buy a mutual fund today at $10 per share, if they bought stock inside of that mutual fund at $8, you've already got $2 or 25% growth embedded as a capital gain tax. The other thing that's happening inside of all of those mutual funds is those money managers are buying and selling constantly. And so the distributions that come out of non-qualified investing are basically taxed as ordinary income, which again, stack on top of your highest marginal bracket, get into adjusted gross income, which then also impacts your Social Security taxation. So even though we have non-qualified, that still can impact your tax load and can impact your Social Security benefit as well.
Well, I find it a curiosity, and we always find this out sometime in January, in late December, at the end of December, they start calculating your fourth quarter and your year-end totals. I noticed one of my funds didn't do well, okay, so it was a loss. But then about a week later, I got a 1099 for a fund that lost money. Now, I'm just trying to be the normal consumer watching our show right now and say the same thing. How can I have a tax on a fund that lost? And I think you just answered it through this, what did you call it, 12B trailer or something?
Well, we call it a loser's tax is what we do, because you lose money, but at the same time, that money manager has been selling those types of stocks inside his or her mutual fund. So they may have bought a stock at 8, you bought it at 10, and it rose to 12 and then fell back down a little bit. So the overall fund had a loss, but you've still got an embedded gain in there. And so you're going to have to pay tax on the 8 even before you owned it. That's the problem with some of the non-qualified mutual fund investing.
Now, so when I'm looking at life insurance as an alternative, if I'm hearing you correctly, if I'm in a low tax bracket, I don't have any matching from my employer, I should be looking at this as a real deep value proposition.
Yeah, and I think one thing that we haven't spoken about is the amount of client control. Within a 401k, you're limited to those funds and that platform that employer chooses. Within the non-qualified world, you take complete control and responsibility for your success of a retirement and income strategy, and you open up an unlimited opportunity of non-qualified assets, and there are plenty of choices within the life insurance industry for life insurance, whether it be participating whole life, variable universal life, traditional universal life, or now index universal life. There's a lot of different options for a variety of conservative to aggressive investors.
Well, that's all the time we have for today's show. I want to thank Mike McGlothlin for being our special guest and today's Money Mentor. And keep in mind, before moving forward with any of the ideas on our show, always consult your tax advisor or legal counsel. And remember, as the good Reverend John Wesley once said, make all you can, save all you can, give all you can. I'm Steve Savant. I'll see you next week.